Hi everyone, welcome back to my channel. Thanks for joining me today, and if you are new to this channel, please consider subscribing in this channel. So let's move on to the topic. Today we are going to discuss on business services. So first of all, we can discuss what does mean by business services. The term business means an enterprise or a firm involved in the trade of goods and services. At the same time, service includes intangible products such as accounting, banking, consultancy, education, etc. When we combine these two terms together, we'll get the complete meaning of the term business services. That means business services are those services which are used by business enterprise to carry on business activities smoothly. Now we can discuss about the nature of business services. So first one, intangibility. So intangible in the sense business services are intangible, which means they cannot be touched. That is, the services can only be felt or experienced by the consumers. So the one of the important natures of business service is that intangibility. Then the second one, it is inconsistency. Inconsistency in the sense they are inconsistent in nature, that is, services are inconsistent in nature. That means there is no standard fix for the services, that is, according to different customers needs and their demands, these services are performed exclusively as per the needs and demands and expectation of the consumers. So that we can say business services are inconsistent in nature. That is, no consistency in the pattern of performance of such kind of business services. Then third one, it is inseparability. Inseparability in the sense this business services cannot be separated from the production point to its consumption point. That is, these services are consumed as they are produced. There is no distinct time for consumption and production. When it is produced, that at the same time it is consumed. That is another feature, inseparability. And fourth one, it is inventory or non-stocking. Inventory or non-stocking, which means services cannot be performed earlier in order to use later. That is, we can produce goods for the consumption which will be happening in a future date. But in case of service, the services cannot be performed earlier in order to use it later. That is, they are only performed when the customer asks for it. So that is why the nature of business service include inventory or non-stocking. Then fifth one, it is involvement. Involvement implies that in the service delivery process, consumers can participate a lot and can change or modify the service according to their requirement. That is, the consumer is having an involvement in business services. So that is why involvement becomes a nature of business service. That is, as per the demands and requirements of the consumers, the performance of services are changing. So that is, it is dependent on the involvement of consumers. So nature of business service includes these 5 points. Then we can move on to types of business service. Types of business services mainly consist of banking, insurance, transportation, warehousing, communication, etc. Now we can discuss each of these types of service individually. First one, banking. Banking is an act of depositing money in banks and withdrawing it when needed. This act is generally facilitated with the help of commercial bank. So banking simply depositing money in the banks and withdrawing it when needed. So we can move on to the definition given for banking by Indian Banking Regulation Act 1949. Remember the year Indian Banking Regulation Act was passed in the year 1949. Banking means accepting deposits of money from the public for the purpose of lending or investment of deposits of money from the public repayable on demand or otherwise withdrawable by check, draft, order, etc. This is the definition given for banking as per Indian Banking Regulation Act 1949. Now we can have a quick idea of different types of banks. Banks can be mainly classified into four. That is, first one commercial bank, then cooperative bank, then central bank and specialized banks. So commercial bank is that financial institution which accepts deposits from the public and offers loans for the purpose of either for consumption or for investment. Such kind of banks are called commercial banks. Simply, a commercial banks is that kind of financial institution which accept deposits from the public and offers loans for the purpose of consumption or investment. Then these commercial banks are governed by Indian Banking Regulation Act 1949. The point should be noted here is commercial banks are governed by Indian Banking Regulation Act 1949. Then this commercial banks can be classified into two, that is public sector banks and private sector banks. These commercial banks can be classified into two, that is public sector banks and private sector banks. Here, public sector banks are those banks where the government has a major stake and they mainly emphasize on social objectives rather than profitability. That is, public sector enterprise mainly focuses on social objectives rather than profitability, and the government is having a major stake in public sector banks. Then about private sector banks, these are those banks where the private promoters are the owners or managers or controllers and they are free to operate as per market forces. That is private sector banks. We can give example for public sector banks as State Bank of India, Punjab National Bank, etc. And in case of private sector banks, hope you all know the names ICICI Bank, HDFC Bank, Axis Bank, South Indian Bank, etc. Then we can move on to cooperative banks. Cooperative banks. Cooperative banks are governed by the provisions of State Cooperative Societies Act. And these banks are formed to provide loans to its members, mainly to provide loans to its members and also to provide agricultural financing. That is, they are important source of rural credit, that is agricultural financing in India. So this is about the cooperative banks. Then third types of bank is that central bank. Central bank. Central bank is the apex bank that controls, this is the apex bank that controls the entire banking system of a country. and it is the sole agency of note issuing in a country and serves as a banker to the government. Central bank serves as the banker to the government. Then the Reserve Bank of India is the Central Bank of India. Central Bank, otherwise we can call it as RBI. Reserve Bank of India is the central bank of our nation India. So this is about the central bank. Next types of bank is specialized banks. They are foreign exchange banks, industrial banks, developmental banks, etc. Their main agenda is to cater the services of their respective domain. That is, their specialized agenda is following through this bank. They are providing services to the particular area in which their domain is concentrated. So here foreign exchange banks focuses on foreign exchange transactions, foreign trade and all, whereas industrial banks agenda is to promote industries, industrial development, etc. And developmental banks supports developmental projects like infrastructural development projects. Such loans are availed through developmental banks. So these are the different 4 types of banks. Now we can discuss banking services. Different banking services are offered by banks, including accepting deposits, lending money, issue of bank draft, pay order or banker's check, real-time gross settlement, national electronic funds transfer, e-banking, etc. In that we can discuss each service in detail. Here the first one, it is accepting deposits. Accepting deposits. Accepting deposits here means accepting deposits from the public in the form of either demand deposit or time deposit. Demand deposits are those deposits which are withdrawable on demand, and it includes mainly 2 types of accounts, 2 types of deposits, that is savings account deposit and current account deposit. Within that, savings account deposits are those deposits which are payable on demand and checks can be drawn against these deposit. In case of savings account deposit, check can be drawn against this deposit and it is payable on demand. Whereas current account deposits are those deposits which are also payable on demand and checks can be drawn against these deposit. But the difference between this savings account deposit and current account deposit is that in case of this savings account deposit, there is restriction on number of withdrawals. There is restriction on number of withdrawals that can be made from savings account deposit. But in case of current account deposit, there is no restriction or there is no limit on the number of withdrawals. Also, there is a particular feature for this current account deposit, that is a check of higher amount can be drawn even if the limit is decided by the bank. A check of amount having higher amount can be drawn against current account deposit. Then we can discuss time deposit. Time deposits are those deposits which cannot be withdrawn before a specified time period. That is, there is a maturity period on this kind of fixed deposit. That is, mainly it includes 2 types of accounts. That is, time deposit includes fixed deposit and recurring deposit. Here fixed deposits are not payable on demand. Also checks cannot be drawn against such deposits. And here maximum period for fixed deposit is that 10 years, maximum 10 years and minimum 7 days. In case of fixed deposit, The maturity period against a fixed deposit is that minimum 7 days and maximum 10 years. In case of recurring deposit is a kind of time deposit where these are special type of fixed deposit in which people save a fixed amount every month for a fixed period of time. However, it cannot be withdrawn before maturity. Here also the maturity is a matter, and here also it is not repayable on demand. That is, recurring deposits are the depositors is saving a part of their income as a fixed amount in every month for a fixed period of time, and it cannot be withdrawn before the maturity. That is the difference between fixed deposit and a recurring deposit. Fixed deposit, we are investing a lump sum amount for a fixed time period, where the time period should be minimum 7 days and maximum 10 years, and it is not payable on demand. Recurring deposit here repetitively, that is either in each month or quarterly, the depositor is investing or saving their amount in their recurring deposit account, and they are withdrawn by maturity date. So this is recurring deposit. The second important function done by banks are lending money. Lending money in the sense they are granting loans and advances by keeping a certain fraction of their total deposit, that is including demand and time deposit, in the form of legal reserve ratio. That is, keeping aside the legal reserve ratio, the banks are lending or granting loans and advances to the customers. Then lending money may take the form of the overdraft facility. Lending money can be in the form of overdraft facility. Second one, cash credit. Then third one, short-term loans. Fourth one, discounting bills of exchange. So what is overdraft facility? Under this, commercial banks allow their customers to overdraw their current account balance up to an agreed limit against some financial securities such as shares, bonds, etc. And the bank also charges interest and do not pay any interest on such account. That is the lending money through overdraft facility. That is, current account holders can overdraw their account up to a certain limit, and that is what called the overdraft facility, and an interest may be charged on overdrafted amount. Okay. Then second, it is cash credit, another lending money in the form of cash credit. Cash credit against some security, and customers can withdraw funds from their accounts up to the sanctioned limit. There is also a sanctioned limit is mentioned, and up to that sanctioned limit, by keeping certain security, the customers can avail money from the bank. That is the cash credit facility. And next, it is short term loans. Short term loans are those loans given as a personal loan, and the whole amount granted is chargeable to interest. These are mainly given as personal loans, and the whole amount is chargeable to interest. Then fourth lending money form is discounting of bills of exchange. Under this, a holder of the bill of exchange can get it discounted from the bank before the maturity date, and the bank's charges commission on the same. And if we are getting the bill of exchange discounted from the bank, then the bank will be charging a commission on the discounted bill. So this is about the lending services offered by the bank and the different ways in which the money is lended includes these 5 types. Okay. Then the third service offered by banks are issue of bank draft. A bank draft is a type of check which is drawn by a bank either on its own branch or on another branch or another bank. It's a very convenient, cheap and safe method of remitting money from one place to another. In order to remit money through a bank draft, a person first obtains the bank draft from the bank, and for this purpose he fills in a form and pays the amount of the draft along with the prescribed commission. Then the customer sends the bank draft to the receiver by post, and when the receiver gets the bank draft by post, he deposits it in his bank, and the bank collects the payment from the concerned bank and credits to the customer's account. So this is another bank service offered by the bank's issue of bank draft. That is, we all know the cases where we are attaining bank draft. We are getting bank draft on certain university matters, or such kind of even business can avail of this issue of bank draft facility. There are a lot of situations where we can avail the issue of bank draft. Then next it is pay order or banker's check. Pay order or banker's check. It means the bank draft which is payable within the city or town. That means it may be called a local bank draft. This pay order or banker's check can be called as local bank draft. Local bank draft. Banks issue pay order for local use and issue bank drafts for outstation. That is, pay orders are issued for local stations, and outstations are the draft issued for outstation is called draft. Okay. Here, the commission charged for a pay order is lesser as compared to bank draft. While comparing this bank draft and pay order, here the commission will be lower in case of pay order, whereas in case of bank draft, commission will be higher. Then next it is RTGS. RTGS, when it how it can be expanded? It can be expanded as real time gross settlement. That is an important term. Sometimes we can get questions like this. What is the term T stands for in RTGS? Here we should note the thing that is real time gross settlement. RTGS means real time gross settlement. It's a fund transfer system under which transfer of funds takes place from one bank to another on a real time and gross basis. Here real time means no waiting period in payment transaction. That is, the transaction is immediately carried out and the transaction is settled as soon as it is processed. So gross settlement means the transaction is made on one-to-one basis without bunching or netting with any other transaction, and it is considered as the fastest possible system for transfer. It is the fastest possible system for transfer of money through the banking system. This is what the another banking facility offered by the banking service offered by the banks. RTGS, real time gross settlement. The next it is National Electronic Funds Transfer. NEFT stands for National Electronic Funds Transfer. Since November 2005, NEFT has been exponential growth, and it is a countrywide system by which an individual firm or company can electronically transfer funds from one bank branch to another individual or firm or company having an account with any other bank branch in the country. And this fund transfer takes place at a particular period of time. There is the time period is mentioned. NEFT transactions are taking place during a particular time period or period of time. The next it is e-banking. Another service offered by banks are e-banking. It means electronic banking or banking using electronic media. That is, here electronic medias are used for banking services. That is why it is called e-banking. And e-banking is a service provided by banks that enables a customer to conduct banking transactions such as checking accounts, applying for loans or paying bills over the internet by using a personal computer, mobile telephone or handheld computer. And this e-banking includes a range of services like electronic fund transfer, automated teller machine, that is ATM, then electronic data interchange, that is EDI, then credit cards and electronic or digital cash. Then e-banking, the electronic banking is carried through different ways, and the different ways of e-banking that I discussed now, that is ATMs, then debit card, credit card, internet banking, mobile banking, etc. So ATM, that all you know, that is, it is 24 hours operated automatic machine which helps in withdrawing and depositing money, and it is done by inserting card and entering personal identification number, that is PIN. Then debit card, that debit card is a way of e-banking. Here a card is issued to a customer in lieu of his money deposited in bank, and instead of the money deposited, the banks are issuing a debit card, and using this card customer can make immediate payment of purchased goods and services. The next ways of e-banking is that credit card. Credit card is a card issued by bank to those customers who enjoy good reputation. That is, it is a sort of overdraft facility, and it is not necessary that a customer should have money in the bank to get credit card. That is, customers can buy goods and obtain services using it and keep on depositing money used in the bank according to the agreement. Then next it is internet banking. Internet banking means any user with a personal computer and browser can get connected to the bank's website to perform any of the virtual banking functions. That means he can avail any of the bank services, and in this there is no human operator to respond the needs of the customer. That is the internet banking. And next it is mobile banking. Here instead of computer and internet we are using, instead of computer we are using a mobile phone. That is, it is a system that allows customers to conduct financial transactions using a mobile phone. For this facility, customers have to register themselves to enjoy the benefits such as mobile alerts, etc. So these are all about the banking services. Now we can discuss on the second type of business service, that is insurance. Insurance is a form of contract under which one party agrees in return of a consideration to pay an agreed sum of money to another party to compensate the loss of goods or life. That is, we can say that insurance is a contract by which the loss is likely to be caused by an uncertain event is compensated by the insurer. We can simply say as insurance is a device for the transfer of risk of individual to an insurer who agrees for a consideration to assume to a specified extent losses suffered by the insured. That is what the service called insurance. Here we should note certain terms related to insurance. Mainly, first one, insured or assurance underwriter. Insured or assurance underwriter. The person who gets his life or property insured is called insured or assurance underwriter. That is, for example, if I am taking a policy from LIC, here my life is getting insured by the LIC, and here insured is myself and the insurer is the agency that offers insurance to me. That is, LIC is the insurer. Okay, so insurer is the agency or firm. Insurer is the agency or firm who insures the risk of loss is called a insurer. And next important term relating to insurance is policy. Policy is a document carrying written agreement or contract. It's a document carrying written agreement or contract between the insurer and the insured along with terms and conditions of insurance. The next term relating to insurance is that premium. A small periodic payment for a risk of large possible loss is called premium. That is the amount payable by the insurer to the insured for getting the coverage of risk is called premium. Okay. These are the main terms relating to insurance. Now we can move on to the functions of insurance. First one, providing certainty. Providing certainty. Providing certainty. That is, insurance cannot remove the uncertainties of the business, but it gives certainty of payment of loss, and in order to provide that certainty, the insurer charges an amount called premium. Then second function is that protection. Insurance cannot stop the happening of a risk or event, but it can compensate for losses arising out of it. That is why it functions like a protection. Then third one, it is risk sharing. Risk sharing is another function of insurance. That means on the happening of a risk event, the loss is shared by all the persons exposed to it, and the share is obtained from every insured member by way of premiums. Then fourth one, it is assist in capital formation. Another function of insurance is that assist in capital formation. The accumulated funds received by way of premium are invested in various income generating schemes, and in this way insurance assists in capital formation. So these are the functions of insurance. Now we can move on to types of insurance. First type of insurance is life insurance, and the second one fire insurance, third one marine insurance, and the fourth one health insurance. Here the first one, life insurance. Life insurance is a contract by which the insurer, in consideration of a certain premium, undertakes to pay the person for whose benefit the insurance is made a certain sum of money on the death of the person whose life is insured or on his attaining a certain age. That is, life insurance encourages savings as the amount of premium has to be paid regularly, and it provides a sense of security to the insured and his dependents. That is what the life insurance. Then second type of insurance is fire insurance. Under fire insurance contract, the insurer undertakes on payment of the premium and subject to the conditions of the contract to pay or make goods any loss or damage by fire which may happen to the property insured during the period covered by the policy up to the amount specified in the policy. That means normally the fire insurance policy is for a period of 1 year, after which it is to be renewed from time to time, and the premium may be paid either in lump sum mode or in installments. And a point should be noted in fire insurance is that in order to claim for loss by fire, they must satisfy the following two conditions. That is, there must be an actual loss, and the second one, fire must be accidental and non-intentional. Then only the fire insurance claim can be get approved by the insurance agency. Then Then third types of insurance is that marine insurance. Marine insurance contract is an agreement whereby the insurer undertakes to indemnify the insured in a manner and to the extent thereby agreed against marine losses caused by perils of the sea. That is, in case of marine insurance, the marine losses are indemnified by the insurer, and that arises due to the perils of the sea, which includes collision of ship with the rock or ship attacked by the enemies, fire and captured by pirates, and actions of the captains and crew of the ship. Then types of marine insurance. Types of marine insurance. Types of marine insurance mainly includes first one, ship or hull insurance. Ship or hull insurance. Then second one, cargo insurance. Cargo insurance. The third one, freight insurance. Freight insurance. So ship or hull insurance is an insurance policy that is to indemnify the insured for losses caused by damage to the ship is called ship or hull insurance. Then cargo insurance. Here the cargo while being transported by ship is subject to many risks, and this may be at port, that is risk of theft, lost goods on voyage, etc. The cargo insurance policy covers such risk. That is, insurance mainly for covering the cargo is called cargo insurance. Then freight insurance. Freight insurance is if the cargo pay does not reach the destination due to damage or loss in transit. That is, during transportation, if any damage happens or lose the goods that are transported, then the shipping company will not pay freight charges. Freight insurance is for reimbursing the loss of freight to the shipping company, that is the insured. That is what called freight insurance. That is, if the cargo pay does not reach the destination due to damage or loss in transit, here the shipping company will not pay any freight charges. So the freight insurance is for reimbursing the loss of freight to the shipping company, that is the insured. Then fourth type of insurance is that health insurance. Health insurance is that an insurance policy where the contract between an insurer and the insured, or that is, here the insured may be either individual or group, in which the insurer agrees to provide expenses related to treatment and hospitalization of specified diseases at an agreed upon price, that is premium, and depending upon the policy, premium may be payable either in lump sum or in installment. So this is about health insurance. In case of life insurance, either on maturity or on the death of the insured, the insurance amount is paid on. And here in case of health insurance, here the coverage is for the treatment and hospitalization of the insured. Then third business service includes transportation. Transportation refers to the movement of people, animals, goods from one location to another, and the ways of transportation includes either land, air or water. Okay, so here in context to business transactions, transportation removes the hindrances of place and that is it makes goods available to the consumer from the place of production to its consumption, and it is thus we can say it is necessary that to develop our transportation system to keep pace with the requirements of our economy.